Hello, ladies and gentlemen. It's Modern Investing on Pod TV. My name is Sasha Starr, and today guests are Dr. Milan Somberg. Welcome to the show.
Thank you for inviting me. Delighted to be here.
Great to have you. And Jim Eade from Foundation. Welcome to the show, Jim.
Thank you, Sasha. Happy Valentine's Day.
Oh, of course. That goes without saying. And we witnessed yesterday was a great deterioration on the market, spooked by Federal Reserve. The stock went down, every stock almost, and the day was very, very difficult, challenging, but in some cases very profitable. I'm not talking about those with short positions. No, I'm talking about if people expect return from S&P 500, say 6%. If you would buy yesterday NVIDIA on the open at $700 and sold today on the open at $740, you would make the same 6% within 24 hours. Here we're talking about, this is what makes the stock market such a wonderful thing, because it gives people all opportunities. Those who want to make 6% a year, yes, here, take it. Those who want to make 6% in 24 hours, here, it's all yours, take it. So everybody is happy, everybody is doing so well. It's fantastic. Jim, how did you do yesterday and today?
Well, yes, I'm happier today than I was yesterday.
Absolutely.
Yesterday was red and today is green. So it is short term, but the reason the market kind of corrected yesterday was because the inflation numbers that came in for January were a little higher than they were projected. They're still very close to what the Fed's overall target is. So it was an overreaction, in my opinion. But also coupled with that is that people then think that the Fed won't lower interest rates because the inflation number was they predicted 2.9 and came in at 3.1, just a shade above. So then they thought, okay, the Fed won't lower interest rates. And so they hammered some stocks, but they bounced back today. And of course, it's all nonsense. The Fed is going to lower interest rates, and probably multiple times in 2024. So it's just one of those things where it was an overreaction to a little data that was just slightly askew from expectations.
Well, commentators are saying that before yesterday's data, the likelihood of the interest rate going down in May was 61%, and after release of the data yesterday, it came down to 35%. So if that's any indication, so the interest rate will go down, but not like as before 61%, but only 35%. 35% also is not such a small number, and yet we will have a lot of data prior to May.
Absolutely. Right.
And still in February, there's a lot of data, for example, by the end of the week, and the next two weeks, and then March comes. So there's still a lot of data to go through, or so on. And so now I would like to ask Milan, how you're doing in these days?
Well, we hope to see to see the market as represented by SPY drop about 10% before we start buying. Now, there are people who will drive all over town in order to get their groceries for a few dollars cheaper. But when the market is cheaper, they're running for the doors. Fact is, when the market drops and bargains abound, most investors are running for the doors. Our members are buying when the market drops, like they would their groceries. When the market rises, our investors, Monday morning millionaire people, are taking profits, whereas most people are jumping on and buying when the market is expensive. So in the last couple of days, the market dropped 1%. We're hoping to see it drop about 10% before we start buying. So when we see SPY going to $450 from the present $495, we'll be buying some more. So, knowing that the money which we're going to need does not belong in the market because it fluctuates. We know that the market is going to be higher 10 years from now, 5 years from now, probably 3 years from now. But it does fluctuate as much as 30% annually. So the market money that we will need in the short term, the near future, 2, 3, 5 years, does not belong in the market. Then what we have in the market with fluctuations, we know, will rise as it has in the past over 100 years. As you mentioned, Cesar, a little over 6% annually. And you know that most people advising investors, retirees, say that we should live on 4% of our portfolio. And the market is rising 6%, a little over 6%. Really very comfortable. Unless you're cherry picking the stock market, the US stock market, that's important. The American stock market, not the Japanese or the Chinese or the German. The American stock market has done better than any other market has for the last over 100 years, likely to continue. So we encourage our members not to have money in the market they'll need in the short term. Keep the money in the market that they are going to do better than anything else. Now, David Svensson, the late David Svensson, who managed the Yale Endowment Fund, did better, by far better than any other endowment fund of the universities. I don't know how many there are, hundreds, did far better. And he said that security selection, and you're talking here about security selection, and market timing make no material contribution to returns.
He's right. He's right before NVIDIA came in the program.
No, NVIDIA is
right now, everything what he says is a garbage. I'm sorry.
NVIDIA is doing all right in the short term. I want to know, I would like to see how it's going to do over the
If you are losing in the short term, you most likely will lose in the long term just as well. If you're winning a short term once and twice and next year and next 3 years, you will win also in the long term, okay? Now, I would like to ask you this. Let's see if S&P 500 495, so you're waiting until it will fall down to 450 before buying. Okay,
right, yeah.
So let's see, there is another very likely, by the way, scenario that the market S&P 500 will go up to 550 before it will go down to 450.
That's possible, yes.
That's possible, and you're missing a pretty good run of 10%. However, listen, nothing ventured, nothing gained. You decided to wait until it will fall to 450, but let's see, you could be wrong, and most likely you will be. So market will go down to 550. So now let's see from 550 when the trigger, the buy button you will get. At market will continue to go to 600. You will still wait, or you will buy at 550, or you will wait until it will go to 450, which may never happen. So how do you actually behave in this pattern?
We're talking about long-term investing. Now, I used to have, I don't have it anymore, but I tell you why. I used to have $100,000 bet.
I know, I miss it.
Payable by the loser to the winner's favorite charity if the loser is able to beat the S&P 500 over the long term. Over the long term?
How many years?
A decade. Yeah. So, they also said that asset allocation accounts for the largest percentage of portfolio returns. And he also said when you look at the results on an after-fee, after-tax basis over a reasonably long period of time, about a decade, there's almost no chance that you're going to beat the market. Almost no chance.
Almost. Remember, very important.
Almost. But look who said this. Look who said this. This was said by the late David Svensson, who ran the most successful university endowment in history.
And you know what? He's not in this book. And Warren Buffett is not in this book. But let me ask you.
Let me talk to you about this book for a second.
Yeah.
You know, you often open a book up at the bookstore and open it somewhere in the middle and start reading there. Now, suppose you open that book, Market Wizards, and one of the Market Wizards says he gets his ideas because he dreams about it. Yeah, in his dreams, he makes decisions about what. You shut the book and go away and look for other books.
Listen, Milman, late William O'Neill, the publisher and founder of Investors Business Daily, and just very recently acquired by Dow Jones, and I read him for the last 30 plus years. He came up with absolutely incredible rules, and I mentioned them several times, and they are working. Trust me, most of the times. Sell if you're losing 7% on stocks that you purchased. And he even went as far as saying, first sell, then ask the questions. First, you have to sell. When you saw it, sell. Then you start analyze what are the prospects of the company. Would they buy that stock today at this price where it's trading now? What's the future? What are competitors? Really, you go into study and you analyze. And all of a sudden, you will discover that there are several other stocks which represent much better buy at this very moment than one that you just sold. And you say, oh my God, thanks you, Mr. O'Neill.
The important phrase that you stated there was at this very moment. Now, he talked about rules, and you know, rules-based investing is always right. And we have to have judgment-based investing. We have to have judgment-based.
Define, please, rule-based investing. What is that?
Well, you just defined one of them, sell when you go down 7%. That's a rule. So what you're both talking about is being disciplined as an investor. You have certain rules that you follow. And that discipline is very important for any investor. And you can have different rules. It doesn't really matter. There's no magic rule out there, but there are disciplines that you can adopt. And that keeps you from being emotional and being attached by emotion. Yeah. And so that you're just rationally based investor. And then whatever rules that you follow, Milan follows certain ones, Sasha follows certain ones, I follow different ones. You know, all three of us have been successful because we're rule-based investors. We're disciplined.
Stick with your rules. Stick with your rules is important. Don't change.
Yeah, and another his rule was that, again, I learned that well over 30 years ago, never pay up the margin call. When you got the margin call, sell or allow the brokerage house to sell for you. Of course, you're better off selling yourself because
how about don't have a margin account? So how about a rule? Don't have a margin account.
Well, you can have one of my accounts, Core Holdings. I don't have a margin there. Right. I hold the same stuff, collect the dividends, and I even don't consider it really an investment. It's I really don't know what it is, and if I would, I'm fighting every day with the idea to cash it out and get into the market and really play the game. And considering that I may not have so many years ahead of me, I think that's what I, of course, have to do. But I will do it. I think this year I will do it.
Wow. However, that's a major decision on your part.
It is a major decision, but look, unless I will leave to 135, I think anyway, what I will do will be enough to sustain myself and my wife. And my children are doing very well financially, so I really don't have to worry about anything.
Right. Well, here are the rules which we follow, and it totally makes sense. Number one is save. That totally makes sense. If you don't save...
Well, at our age, it's irrelevant. We are not trying to save anything because we have just maybe not so few years left ahead of us, and all we want to do is enjoy life. And I'm going with Nav on very, very expensive Aruba 2 weeks all-inclusive vacation.
Why not?
Save. not to say
Oh, wait a minute, Sasha. At your age, probably you shouldn't need to save anymore.
I don't need.
If you have done everything right at your age, you shouldn't need to save. But
Sure.
at the beginning of your career, and probably that's one of the most difficult things for people to do, to save 10% of their income. And I keep saying to my children, save 10% of every dollar you ever earn. And now, if you save, that's number one. If you don't do that, the other five don't matter. Number two is do it yourself. And people who are watching this program are doing it themselves. Do it yourself investing over the course of an investment lifetime will save a full year's income. A full year's income. That's number two. Number three is buy the American market as a whole. Don't pick stocks.
I like to say that I was disciplined, but I also was lucky, because the thing I did when I was first starting out, first getting a paycheck, was I had a deduction from that paycheck before I even saw the money, because in my early 20s I would have spent it. But if you had, I invested in the company that I was working for, which was AT&T at the time. It broke up into the baby bells, and so I ended up investing in Pacific Bell, and people thought it was a weak sister, but it did very well. So I was lucky, but I was also disciplined, because every single paycheck was invested, and my company matched 6%. So I got the 6% that Milan's talking about right away. But if that company had gone under, if that company hadn't done well, I could have been in an entirely different situation. But it was the discipline of investing every single paycheck, a small amount. I forget what it was, but it was at least 10% matched by 6%.
There are three factors which contribute to the size of the savings. Number one is the amount you contribute. That'd be obvious. Number two is the interest that money earns while it's being saved. And number three is the time that it's working for. And that time factor is the most important of the three. So that if you start with a small amount, but give it a lot of time, because you start investing the very minute you get a first job, that adds up. So the time is the most critical factor. Saving more is nice, but very difficult. Saving 10% is very difficult for most people. They got mortgages to pay and kids to raise. Raising an average child from diapers to diplomas is a matter of $300,000. If you got a couple of children, there's a lot of money that you need for the children. So saving is difficult, but
doing that discipline allowed me to buy my first home. And so that was one of my early goals as an investment, because even if the home prices went down, I could still live in it.
Yeah. So, did you say that one of the companies that you worked with was Charles Schwab?
Yes. After I started out with AT&T and did that, but then I went to work for Charles Schwab, which again, I was lucky. Schwab did fantastic while I was there. So
talking about luck, I mentioned this before. I was born in 1940, just as in Belgrade, just as the Germans invaded Yugoslavia. And a bomb fell on the house next door and killed everybody in it. Next door. And here I am talking to you. It's entirely a matter of luck, that is. And so much. The fact that you worked with Charles Schwab is a matter of luck, because it was not one of these companies that tanked, as many did. Nortel, the Charles Schwab is not Nortel.
Right.
And Pennsylvania Central Railroad, and who knows what else. So, that luck plays a role for sure. And so somebody said, better to be born lucky than smart.
Yes. Well, and the idea though is that discipline will pay off in the long run. But if you are successful, never forget that you also had a little luck along the way. Don't get too cocky. Because I think that's goes along with the discipline is a little bit of humility too. Because when I make a bad decision in the stock market, I don't beat myself up. I just say, well, this is a numbers game. I'm not going to be 100% right all the time. So, just stick with your discipline. Don't change it up. Don't start using different rules just because you made a bad choice at one point.
If we do things right, mistakes are practice shots, really.
And learning experiences. That's every mistake that I made, and it's like Sasha, you and Milan, this. After a chess game, you're better off analyzing your losses than you are analyzing your wins. It's more fun to analyze your wins, of course, but you learn more by analyzing your losses. So,
absolutely. And Jim, the reason is that when you win, in many cases, at least in my cases, I'm winning because of my opponent's mistakes.
Sure.
I cannot play a perfect game as a Magnus Carlsen or Kasparov or something in this league. So obviously my opponent most likely made mistakes, which I capitalized, and there is very little probably to learn. But when I'm losing the game, especially against strong opponent, there's a lot to be learned. First of all, you analyze, you see your mistakes, where you could play a little bit stronger and better. You see very interesting moves by your opponent, and you start to appreciate these moves. So absolutely, totally agree with you. I'm also analyzing stock market. I do lose some trades.
Absolutely.
And I also do analyze. And you see, I found that some of the trades I'm losing because I broke the 7% rule. And the reasons that I broke it is that for example, I sold on Moderna recently. I saw that the stock is moving higher, and I sold cash covered puts. And stock, almost the moment that I sold them, stock started to go against me. It started to go down. Okay, that's okay, because I still have a pretty good cushion on the put. But nevertheless, I was exercised. Now, when I was exercised, I was losing more than 7%. So now what to do? Okay, you might try to start selling covered calls, but the premiums are really lousy. Then I started to say, okay, for example, if I will sell, take a loss, what would I do with the money? Here comes NVIDIA. Say, sell, sold, NVIDIA in. So essentially, right now, I look at my portfolio, I have only 3 positions. NVIDIA, but NVIDIA have a lot of positions. You have the stock, several hundred shares, covered calls at 7:40, which expiring this Friday, which is day after tomorrow. Stock is around 7.25 or so. So there's a chance that I will keep the premiums. The premiums are fantastic. Maybe I will keep the premium. If not, stock will be taken away at 7.40, generating very good profit. Now, I also sold cash covered puts. Same Friday, day after tomorrow. The expiration, the price is strike price 7.30. So it's now interesting position. For me, ideal scenario, if the NVIDIA will close between 7.30 and 7.40. So what will happen? I will keep all the premium from the puts. I will keep all the premiums from the calls and still have several hundred shares fully paid for and free of covered calls or cash puts or so on. But we'll see. I'm not sure.
Sasha, a no-brainer way of investing is to sell covered calls on the cash position that you have, buy SPY, sell covered calls on it on a Monday expiry date, Friday of the same week.
What's the problem with this proposition?
Let me finish.
Okay.
Keep on doing that, and receiving the premiums until you're assigned and the stock is called away from you. Now you're in cash, which allows you to sell cash covered puts.
Excellent.
So now you keep selling cash covered puts again until you're assigned. Now you own the stock, again, and then you sell
Milan, there is one, actually 2 problems that prevent me from doing that. The number one, the movement on NVIDIA in 1 week exceeds the movement of S&P 500 in a year. Most
people, Sasha, most people can pick NVIDIA with hindsight only. Because you're buying NVIDIA from somebody who's selling it, you can't both be right. One of you is wrong. Either the seller is wrong if the market goes,
Milan, we heard that suggestion from you several times, and several times I was fighting with you on that. So I will leave it for you. Okay,
Well,
so you're right.
We'll also say that both Sasha and I selected NVIDIA. I bought it and at a much lower price, and then I sold it. If I had used Sasha's rules and invested the way Sasha would, I would have made more money. But I did make money, and so NVIDIA was kind of, if you were paying attention, kind of like asking to be bought at one point. It was like, if you were an experienced investor, it was one of those stocks that, you know, it was hard to see how it was going to lose. It was in the right spot at the right time, doing a good job at what everybody needed. Not everybody, of course, but
so who did you buy it from? Who did you buy it from? You bought it from somebody who sold it, right?
Yeah,
Oh.
yeah, or the market makers. You know,
Yeah.
I don't know who, and I didn't care who.
You know,
But Milan, again, your point that you bought it from somebody. Of course, you bought it from somebody. You didn't buy newly issued shares. You bought shares which are
right now.
trading. So there are market makers, there are mutual funds, there are hedge funds. There are 25 entities plus millions of investors who could sell you that stock potentially.
And my take on it, I bought it like say 280. I'm making up numbers now, but and sold at 480. I hit my target and I sold. Now the person that bought it at 480 is also happy because
stock is 777.
Okay, you know, if you take a look at go to Wikipedia and take a look at the Rothschild family homes. Every one of them is a castle. They have made an enormous amount of money, the Rothschild family. One of them said, I made my money by selling too soon.
It's not only
that's what I did with NVIDIA.
there is a famous investor, Baruch, who also said,
Bernard Baruch, yeah.
He said that I sold some stocks too soon, but you cannot lose by selling stocks too soon unless you are selling losing stocks and you are taking a loss. Then you may be punished because there's a lot of people. Trust me, they're not waiting for 7% until stock will lose. Some people buying stock as soon as they see red. They liquidate it right away without even asking a second question. Stock can recover in the next 15 minutes. They don't care. They don't want to see the red.
Would it be true, Sasha? Would it be true, Sasha, that most investors are wrong most of the time?
Well, I would say to that, Milan, you alluded to why this happens. People buy when the market is going up, and they sell when the market is going down. Now that's the opposite of what I do. And
good for you. Yeah, that's the opposite of what we recommend.
Right.
When the market goes up, you take profits.
Exactly.
When the market drops, you buy bargains.
No, in case of NVIDIA, I disagree with you.
Well,
Actually, you're better off by.
And you were right. I sold too soon.
But just think about something. Let's say you bought NVIDIA, just numbers, say 200 a share. So you bought 100 shares. Now stock is 400 a share. So there is a great temptation to sell and get your profit. Okay, right. It's nothing wrong with that.
You know, Sasha,
but there's another strategy to buy another 100 shares at 400. So now you're sitting on 200 shares with your average price 300 and stock is trading at 400. What's wrong with that?
Very, very good.
Well, Sasha, you're talking about, and I think this is probably the basis of modern investing, is momentum investing. Stock, a security is much more likely to continue in the direction that it's going than it is to reverse itself. But sooner or later, it will reverse itself for sure.
But look at if you.
Momentum investing, as it goes up, you can keep buying more because it'll keep on going up until it doesn't.
The greatest investment returns, such as, for example, Jesse Livermore, and I studied a lot what he was doing, but it was different time, different markets, different systems. He was picking up one position. It could be currencies, it could be stocks, it could be almost anything, oil, or just doesn't matter what it is, secure some kind of security. And when things started to go his way, he immediately started to multiply his position. He was taking one position, say one contract, As soon as it moves his direction, he has 3 contracts, 5 contracts, 7 contracts. He builds up like a pyramid, a huge holdings. And that one position would generate for him profits that people can make during 5-10 years time. But he would do that in 2-3 weeks.
Dollar cost averaging on the way up.
Yes, that's what it is.
Jesse Livermore committed suicide because he thought he was a lousy investor, didn't he? He committed suicide. Why? He left a note. He was a lousy investor.
Perhaps at that time, maybe he was a lousy investor. But people are not study the circumstances of his death. People study what made him the well-known investor who was winning and losing fortunes during his lifetime.
Yeah, right.
It wasn't an easy way for him, but considering where he started, he had a very poor social regions and so on, and he was working his way up, but he was absolutely incredible at studying the tape. Of course, at that time, the only people who could see what's happening with stock was the tape. And he was fantastic at reading the tape, the prices, the volume, the securities, and he was glued to the screen, reading the tape and making his decisions. And
you could take a look at Jesse Livermore's yacht, and it would astound you. So there was this young man who inherited a great deal of money, so he was taken by a Wall Street broker, showing him around, and so because he wanted the business, the broker wanted the business, so he said, yeah, and this is Jesse Livermore's yacht, and this is JP Morgan's yacht, and so on and so forth. And the man said, where are the customers' yachts?
Very good point.
You don't need to be their customers. You can do a lot of things on your own, but you need confidence. You need conviction. You have to understand the market. You have to understand what's happened yesterday. When so many people put stop losses, and the market makers and brokers and everybody else have to take people out of their stop losses. So the next day market, when they will return, there are no investors. They're already out through their own stop losses. That's really what's happened yesterday. Nothing more, nothing less. So the stop losses were liquidated. Investors were separated with their money. And now the stock market can continue driving back.
Going to continue to go up, in my opinion, and it will not go up in a straight line.
Yeah, exactly.
No. Even if you take a look at NVIDIA chart, it's trading now around 730. It was in the morning as high as 740 something, 743 maybe. And it went down all the way to 723. Okay? It's a big move, $20 down. It's 1/3%, because it's expensive stock. We're talking about a lot of money. Now it's recovering. It's almost 730. And I think that by the report, which is due next Wednesday, I have no doubt that the stock will be 750 and higher.
Hey, Satya, remember I talked a lot about Taiwan semiconductor manufacturing?
Yes.
I around 110. I'm just noticing, to my chagrin, it's selling now at 129, almost.
Okay.
So the person who bought the stock from me is also happy.
Wonderful. That's
a question. Again.
You know, one of the main difficulties that I see with your style of investing and picking stocks is the amount of time that it takes to monitor these things. You know, most of our members, a Monday Morning Millionaire, we have about 300 members, mostly professional people, and they make more money on their job, practicing medicine, dentistry, law, whatever it is that they practice, than they will in any 1 week in the stock market, particularly at the beginning of their careers. And they're much better off focusing on their careers than they are on the stock market.
Of course, you're right.
Your approach requires constant attention, whereas what we
well, listen, those people who work as the, let's see, proctologists, it also requires a lot of attention to details, and I don't think that people are happier than trading stocks.
the thing is that both Sasha and I enjoy it. So it
Oh,
is,
yeah, absolutely. If you enjoy it, you should be doing it. Particularly, you devote the time to it. And so we recommend, for example, for our members, is when they pick stocks to do it in a portfolio that they wouldn't mind losing everything. That is,
absolutely
put in
discretionary fund.
a certain amount of money that if you lose it all, you're still going to be all right. That's number one. And number two, don't keep track, because if you do, you will almost certainly be disappointed.
Not in my case. I kept the track. I generated in 12 months of 2023 profit of 188%. So it didn't hurt me at all to keep the track.
Well,
To tell you the truth, I didn't even understand the size of my profits, because, okay, it just, you go from position to position, there are options, they're expiring, there's new options and so on. So I didn't even notice, except one thing, that the position where I, for example, like before, I would say sell 2 NVIDIA puts, all of a sudden I could sell 4 NVIDIA puts, and now 6 NVIDIA puts. So then I realized that, okay, my account grew so much that I can take much bigger positions. And then on December 23rd, 24th, on Christmas Day, I've looked at my return for 12 months, and it was 188%.
Sasha, you're a market wizard. Most people aren't.
Maybe.
Warren Buffett has had the most successful investment record over the last 60 years. He was not able to equal SPY the last 5 years. And in fact, the money that he's leaving to his wife is exactly the way we describe it. Buy SPY and invest the way we talk about. Buy the U.S. market as a whole. Don't pick stocks. This is a man who's...
As a rule, you're both right. You're just appealing to different types of individuals. And so, one, I'd just like to change the subject a little bit, because the one red on my screen, which is all green, is Apple. And Apple has been going down, getting some bad news. And I guess the latest release, it was a VR type of device that seems to be too pricey and doesn't seem to have an audience. So even a great company like Apple has been a great company, can get beaten down in the short term. So this is the type of thing. If you're going to buy individual stocks, you have to be prepared to see even a good company go down. And this is kind of this one. I'm not. I don't know. Like Sasha, you tell me about your 7% rule. Like if my stock has gone up, like Apple went up almost 100% from what I bought it, and now it's gone down. Should I be going for the 7% rule from what I sold, or from its high, or from when I bought it?
Thank you, Jim. It's a very good question. In what recommended William O'Neill was from your purchase price. You should not allow to lose in one position more than 7%.
Okay.
However, if you follow the gambling rules, I would not call it gambling rules as well as the self-discipline and money management rule, rather. The way I play, for example, in a casino and blackjack, which I'm going to do a lot in Aruba. What I will do is, let's see, the same $100, and I'm playing, and let's see, my payroll went to $200. And then I would lose, but in casino, I don't use 7% to default calculation. I use 10%. So now from 200, if I lose $20, it's 10% from 200. I terminate the game, stop the game right away. I'm going to another table, to another casino, or just going just to
change the environment somehow.
Completely change. I have to terminate the losing process.
Right.
So the losing process has to be terminated. Now, the winning process, you never, ever terminate. I never leave the table if I'm in a winning streak. If I keep winning, I will play. I will stay for until 5 in the morning until I will lose.
Has the house ever stopped you from betting any further?
It had me.
Yeah?
Have you?
Why?
Oh yeah. Well,
Yes.
the pit boss will come over because they know I'm counting cards, and
Yeah.
they'll start to try to distract me.
That's a great success story. Great success story. A little aside here. Do you know why Apple has that logo, an apple with a bite out of it?
I have read this, but have forgotten. So I would love to hear it again.
What happened was Alan Turing during the Second World War
Yes.
decoded a lot of German code, and he was a brilliant guy, but he was gay,
Right.
and being gay was terrible during the Second World War at that time in Britain. So he committed suicide, and he committed suicide by poisoning an apple and taking a bite out of it. That's how he committed suicide. So that's why Apple has that in honor of Alan Turing, who, by the way, has been reinstated in Great Britain and was featured on some postage stamps.
And
Jim, I really hope that your apple is not poisoned.
yes.
You'll go okay. Well, with that,
That's why I'm asking, because it's it seems red for a while now on Apple.
Yeah. Well, listen, with that, thank you so much for today's program, and I will see you next Wednesday, same place, same time. Have a very successful week of investing.
Thank
Bye-bye.
you. Bye-bye.
Buy your wife some flowers.
Thank you.
Good point.
Bye-bye. I will buy some tomorrow.